Welcome to the Pro Ticker Deep Dive. Okay, so the core question we are tackling today, it's maybe the trickiest one in digital assets right now. Is Bitcoin's latest surge, this little price rally we've seen, is it actually a sign of a real sustainable recovery? Or is it just, a brief head fake before things get volatile again and drag us back down? Our mission today really is to try and give you some clarity here by diving into some pretty conflicting data points.
Hmm.
Because the key tension, the absolute heart of the matter, it seems to lie between two opposing forces. On one hand, you've got fresh money flowing into regulated investment products, these spot exchange traded products or ETPs. But on the other hand, there's this big shadow hanging over everything, which is the messy global macroeconomic picture.
Right. And if we boil down all the research, the sort of executive summary is this. We are seeing a stabilization. And this move feels structurally different from some previous rallies. Why? Because it seems driven by, let's say, cautious but pretty consistent institutional re-engagement, mostly through these ETPs.
Okay, cautious but consistent.
Exactly. But, and this is a big but, this recovery is inherently fragile. The market is still incredibly reactive to global headlines. Think shifts in inflation expectations, interest rate chatter. That stuff still really moves the needle. So that tug of war between the new institutional demand and that lingering global economic fear, that's the dynamic we really need to unpack today.
Okay, let's start with the fear side then. Before we get too excited about the institutional money, what is actually happening in the wider global economy that's acting like this anchor on the market, keeping a lid on things?
Well, we're kind of stuck in what some analysts are calling a weird limbo. You know, globally, yeah, central banks have mostly paused the really aggressive rate hikes, which should be good news.
Should be.
Right. But they haven't declared victory over inflation. Not even close. And that means bond yields are still stubbornly high. Economic growth signals are, frankly, all over the place, very mixed. Traditional investors are finding it hard to really commit capital. They're sort of torn, between playing defense, worrying about a recession, and then that classic FOMO, the fear of missing out if the market suddenly rips higher without them.
And this uncertain, sort of choppy external environment, it gives Bitcoin a bit of an identity crisis, doesn't it? It can't seem to decide what it wants to be.
Exactly. And that's absolutely critical to understanding the volatility. In this kind of market, Bitcoin gets forced into this dual role. So one minute, maybe there's geopolitical tension or worries about government debt, and investors start treating it like a hedge. You hear the digital gold narrative, a store of value against fiat debasement.
Right, the safe haven play.
But then, literally the next day, maybe bond yields spike or the Fed sounds a bit hawkish. And it just flips. It starts tracking high-risk tech stocks. It becomes a high-beta risk asset, meaning its price swings are often like exaggerated versions of what you see in the NASDAQ, for example. So the key insight for you here, watching this unfold, is that a bad inflation number probably puts pressure on that digital gold idea. Bond yields rising. Expect Bitcoin to act more like a risky stock, this dual identity thing. It's really the source of a lot of the market's recent whipsaw action.
So if we're watching the charts, the big takeaway is, well, it's fundamental. Bitcoin isn't just a crypto story right now. It's very much a global finance story. You really have to pay attention to things like 10-year bond yields and what central banks are signaling. It's not optional anymore. Okay, so now let's pivot. Here's where the institutional story starts to get, interesting. After what felt like ages, months really, of capital just bleeding out of the crypto sector, money is actually moving back in. How significant is this return of positive flows into these spot Bitcoin ETPs, these regulated products? Is it just a trickle or?
It's more than a trickle. I'd say it signals a tangible structural shift in sentiment. These regulated vehicles, they've genuinely become a kind of magnet for fresh allocations. It's completely reversed the months of pretty painful outflows we were tracking earlier in the year.
Oh,
And crucially, this isn't just, retail speculation. This suggests renewed conviction from more sophisticated institutional type investors.
yeah.
People who've likely been waiting for two things, maybe a better entry price, but also, critically, a regulated and secure way to get access.
And the why for them is pretty simple, I guess.
Exceptionally straightforward. For these traditional players, ETPs, remember, these are just funds trading on regular stock exchanges. They are simply the cleanest way in. They don't want the hassle or the liability, frankly, of setting up crypto accounts, managing private keys, worrying about custody regulations.
All that complexity.
Right. The ETP structure handles all that for them. They're essentially buying a regulated security that just tracks Bitcoin's price. Simple.
So the demand signal is clear. Institutions want the exposure, but they want it wrapped in the safety blanket of regulation. It tells us trust is maybe being rebuilt, but slowly, not a speculative frenzy.
Exactly. And we should note, the data we're seeing points specifically to Europe as being a pretty significant source of this fresh capital inflow right now.
Oh, interesting. So Europe's leading the charge on the regulated front.
It appears that way, yes. They seem quite active in adopting these regulated structures.
Okay, let's use that analogy. The ETPs are like the canary in the coal mine for institutional sentiment. Right now, that canary is singing, but maybe quietly, not shouting.
That's a good way to put it. Singing, but not yet a full-throated opera, perhaps.
So, okay, if institutions are consistently putting money in, even if quietly, why haven't we seen that explosive breakout yet? Why does it still feel like we're kind of grinding sideways, not launching into some massive bull run?
Yeah, it's a fair question. And the answer really lies in the nature of this current demand. It's fundamentally different from the 2021 market. This is very much an institution-led move so far, not a broad retail-driven frenzy like we saw back then.
And we can actually see that in the data.
Absolutely. Look at a few key indicators. First, spot volumes. The actual amount of Bitcoin being bought and sold on exchanges day to day. Still pretty modest. They are way below the peaks we saw in the last cycle. That tells you the broad base of regular buyers, the ones who often fuel those really explosive emotional moves, they haven't really returned in force yet.
Okay, so volume is low. What else?
Second, look at the derivatives markets. Now, we do see futures open interest rising, which definitely signals growing professional activity. That's positive. But, and this is critical, funding rates are contained.
Okay, maybe unpack funding rates quickly for everyone.
Sure. So basically, contained funding rates mean that traders using leverage, borrowing money to make bigger bets, they aren't paying a huge premium to hold those positions. In simple terms, it means the market isn't grossly overheated with speculative debt right now. We're not seeing the conditions that often lead to those massive liquidation cascades and rapid price crashes when things dip a bit.
Got it. So less wild speculation, more measured professional positioning.
Precisely. So what we seem to have is a genuine transition phase. You've got this early, maybe cautious institutional re-engagement happening, but it's without that broad-based retail euphoria layered on top yet. It's arguably a much healthier foundation being built, but it's inherently slower, less rocket fuel.
Okay, that makes sense. Let's get technical for a moment then. For people tracking the price action day to day, what are the absolute key levels we should be watching? The lines in the sand that sort of define this transition and maybe reward patience.
Well, the market structure has actually been pretty disciplined lately. We've seen strong support holding up quite reliably around the mid-$20,000 level. Whenever the price dips down there, buyers have consistently stepped in. That signals some real conviction building at that level. So that's your floor for now.
Okay, mid-20 support. What about resistance? Where's the ceiling?
Yeah, the immediate battleground, the real resistance zone, seems to be sitting squarely between $28,000 and $30,000. We've watched the price try and fail repeatedly to break decisively above that $30,000 psychological mark and actually hold it.
So 30K is the big one to watch on the upside.
It really is. If we can get a decisive break, and importantly, maybe a weekly close above that $30,000 level, that would be the technical signal that potentially opens the door for a push towards the next major resistance area, maybe up around $35,000.
And momentum, how does that look?
Momentum indicators are showing stabilization, but not really strong acceleration yet.
Yeah.
We're generally holding above the 50-day moving average, which is, positive for the shorter-term health. But, and here's the other key technical point, we are still struggling significantly with the 200-day moving average.
Right, the 200-day. For those maybe less familiar with technicals, why is that specific moving average always seen as such a big deal, such a psychological hurdle?
Because it essentially represents the long-term trend. It typically tracks the average price over the past 40 weeks or so. Holding above the 200-day is often seen by chartists as the basic definition of whether an asset is in a sustained bull market or if it's still kind of stuck in bear territory or maybe just transitioning.
Okay.
The fact that Bitcoin is still bumping its head against it right now, it confirms what we've been saying. While the short-term picture with ETP flows looks better, the market hasn't fully convinced itself that the long-term trend has truly reversed yet.
That makes perfect sense. Okay, so let's tie it together. If we combine that technical picture, the support, the resistance, the moving averages with the institutional ETP flows.
Yeah.
What are the main things that need to happen? What decides if this steady demand can actually push us out of this range and break that $30K resistance for real?
All right, so the upside potential, I think, hinges on probably three primary catalysts. First, and this is non-negotiable really, You need that continued ETP flow momentum. It has to keep coming in, building that steady, reliable demand base that can help anchor the price floor.
Okay, steady flows are key, number one.
Number two, we need a decisive shift in that macro narrative we talked about earlier,
Hmm.
particularly a softening inflation reading. If inflation cools faster than expected, that could lead markets to price in central bank rate cuts sooner rather than later. And that would dramatically increase Bitcoin's appeal, potentially, as that high beta risk-on asset.
Makes sense. More appetite for risk if rates might fall.
Exactly. And the third factor, which is arguably the biggest potential wild card out there, is any kind of positive regulatory clarity, particularly in the U.S. Any concrete positive movement on that front, especially anything related to approving major spot Bitcoin ETFs in the States, could just instantly unleash a huge wave of institutional capital that's currently parked on the sidelines, purely due to legal and regulatory uncertainty.
Right, the U.S. regulatory question looms large, but we can't ignore the risks either, especially with how shaky that macro environment still feels. What are the major curveballs? What could derail this slow, steady recovery?
Yeah, absolutely. Sentiment risk is still exceptionally high. If macro data turns sour unexpectedly, let's say inflation surprises to the upside again, forcing central banks to maybe rethink their pause, well, we could easily see those ETP outflows return just as quickly as they arrived. These institutions are still cautious. They will pull back allocations fast if the risk profile changes dramatically.
So flows can reverse quickly. What else?
Well, there are also a couple of sort of structural internal market issues that still persist. One is liquidity fragmentation. Trading volume is still spread out across dozens of different global exchanges. That can hinder efficient price discovery sometimes, and it can make executing really large trades a bit more challenging than in traditional markets. The market isn't quite deep enough yet in that sense.
Okay, fragmented liquidity.
And then, of course, there's the regulatory overhang we just mentioned, particularly the ongoing uncertainty in the U.S. Even if Europe is moving ahead, the lack of clarity in the biggest market acts as this sort of constant low-level drag, a ceiling on broad institutional appetite.
Okay, so to sort of wrap this up and bring the core theme back to you, the listener, Bitcoin's current story isn't about hype. It feels much more like a slow, maybe even methodical rebuilding of trust, primarily through these regulated investment channels. It seems to be about quiet, consistent institutional demand trying to build a base, not that loud retail mania we saw before. It's a totally different kind of market phase, it seems, one that maybe rewards analysis more than just pure enthusiasm.
Absolutely. That sums it up well. This is definitely a market right now that demands patience and discipline. To navigate it successfully, you really need to keep one eye almost surgically fixed on the charts. You know, watching that 28K to 30K resistance zone, watching that 200-day moving average like a hawk. And your other eye needs to be firmly fixed on those macro headlines, especially inflation reports, central bank statements, bond yields, because honestly, those external factors are probably deciding the price action more fundamentally right now than almost anything happening purely within the crypto space itself.
And what's really fascinating here, thinking about that European ETP flow, it does seem like Europe is taking the lead on regulated exposure, becoming the main entry point for traditional capital right now, which leaves us with a final thought. Does this actually mean the U.S. is falling behind on institutional crypto adoption? And maybe more importantly, how much is that lag, that U.S. uncertainty factor, currently priced into Bitcoin's ceiling? Something for you to perhaps mull over. See you all in the next Pro Ticker Deep Dive.